As of February 2017, this regular podcast is available on our Andy Yeh Alpha fintech network platform. While the original 5-factor asset pricing model arises from a quasi-lifetime of top empirical research by Nobel laureate Eugene Fama and his longtime co-author Kenneth French, the 6th factor is hypothetical in nature and stems from bullish versus bearish investor sentiment on social media. In addition to the conventional fundamental factors such as size, value, market risk, operating profitability, and asset growth, the social media factor serves as a new measure of investor sentiment. All these factors help explain the time series variation in most U.S. stock returns relative to the risk-free rate. Whether this additional social media factor represents exposure to systematic risk remains a debatable controversy because there is now minimal consensus on this open issue. Several financial economists recommend raising the empirical hurdle for novel fundamental factors such as this social media measure of investor sentiment. On balance, it is informative for most stock market investors to recognize that social media conveys pivotal information about at least part of the time variation in the vast majority of U.S. stock portfolio returns, ceteris paribus. Apple now pursues an early harvest strategy that focuses on extracting healthy profits from a relatively static market for the Mac, iPhone, and iPad, all of which account for 85% plus of Apple's global revenue. Fortune futurists predict that Apple may adopt an aggressive acquisition strategy to consolidate many downstream media providers such as Netflix, Pandora, Disney, and Activision Blizzard. During the Trump tax holiday, Apple seeks to repatriate as much as $250 billion offshore cash to invest in domestic job creation, manufacturing automation, and artificial intelligence. As Apple CEO Tim Cook has indicated its ambitious fiscal plan to double media service revenue in the next 3 to 5 years, Apple needs to complete multiple M&A deals to achieve this high standard, in stark contrast to organic growth. Although many retail investors view this financial news as another speculative stock market rumor, time will tell whether Apple fulfills its medium-term trifecta of top dividend payout, offshore cash repatriation, and massive share buyback prior to 2020. On balance, the world's largest tech giant offers a bright stock market prospect in terms of both robust operating performance and investment efficiency. This nice and clear infographic visualization helps us better decipher the main memes and themes of President Donald Trump's first 100 days in office. This time is no different. It is difficult to predict Trump's eventual presidential fate and legacy. The fiscal trifecta of lower income taxation, new infrastructure, and deregulation has yet to run its natural course. The current interest rate hike continues to boost greenback appreciation. Also, dark clouds of economic policy uncertainty revolve around Trump's diplomatic relations with China, Russia, North Korea, and the Middle East. The present political situation complicates the Republican administration's pro-growth macroeconomic policy agenda. In this light, the Trump stock market rally has not demonstrated its full potential. Apple is now the world's biggest dividend payer with its $13 billion dividend payout and surpasses ExxonMobil's dividend payout record. Despite the slight reduction in the number of iPhone sales in the most recent quarter, 2017 Q1, Apple CEO Tim Cook looks forward to releasing iPhone X as a brand new smartphone revolution. This new product will carry proprietary technologies such as OLED curvy touchscreen, facial recognition, wireless charging service, and artificial intelligence. In addition, Apple plans to initiate sequential share repurchases of at least $200 billion by 2020. In the next few years, the world's biggest tech giant is likely to expand its media service revenue with the financial trifecta of massive dividend payout, share buyback, and offshore cash repatriation. This financial trifecta will enable Apple to attract better dividend clienteles of long-run institutional investors with American focus on supply chain automation, domestic job creation, intellectual capital innovation, and even some further acquisition of complementary tech-savvy startups. This latter horizontal consolidation can travel up the corporate value chain for better vertical integration in terms of both productivity and efficiency gains. One of Apple's upstream suppliers, Taiwan's Foxconn Technology Group, may establish one or more new plants in America in response to President Trump's macroeconomic expansion. President Donald Trump unveils the dramatic tax overhaul proposal. Through this tax plan, Trump replaces the current 7 income tax brackets with 3 leaner tax brackets, cuts the corporate income tax rate by more than 50% with a substantial decline in the effective corporate income tax rate from 35% to 15%, abolishes the estate tax and alternative minimum tax, and then provides new incentives for U.S. citizens to simplify the arduous process of filing tax returns. More importantly, Trump designs a tax holiday for multinational corporations to repatriate hundreds of billions of offshore cash per year to boost America First high-skill job creation, robotic manufacturing automation, tech-savvy innovation, capital investment, and macroeconomic growth. This alternative territorial system is conducive to promoting better stock market performance and economic growth. Although the current Trump tax proposal may result in a fiscal budget deficit of $6 trillion in the next decade, stock market investors and financial institutions such as banks and mutual funds welcome this pro-business tax reform from the Trump administration. The resultant tax incentives can favorably bless the American stock market. Would you rather receive $1,000 each day for 1 month or a magic penny that doubles each day over the same month? At first glance, this counterintuitive question defies the conventional wisdom because compound interest can readily outweigh arithmetic interest over an equivalent time horizon. Indeed, the magic penny would become $10,737,418. Or equivalently 346 times more than $31,000 over the same 1-month period. Successful long-term sustainable value investment focuses on the magic power of compound interest, which Albert Einstein characterizes as the most powerful mathematical tool for exponential growth. Exponential compound interest is thus the key to unlocking long-run sustainable wealth creation. Each investor should reinvest his or her disposable income from cash dividend payout and share buyback to yield interest on both principal and interest income. With the current interest rate hike, large banks and insurance companies are likely to benefit from higher equity risk premiums and interest rate spreads. Pre-crisis U.S. banks such as Goldman and Citigroup carry financial leverage as high as 35-1. Meanwhile, these banks carry financial leverage about 10-1. In this golden age of finance, it is likely for banks and insurance companies to lever up with robust operating profitability to 15-1 in light of post-Dodd-Frank deregulation under the Trump administration. In this respect, financial stocks are likely to experience an imminent boom in stock market valuation. The current Trump stock market rally brings tangible benefits to bank stocks that will likely receive preferential tax treatment in the form of both lower corporate income taxes and indefinite tax holidays for offshore cash repatriation. As the current interest rate hike attracts capital inflows from non-U.S. economic regimes, this hot money will spur macroeconomic growth, corporate investment, and technological innovation with higher wages, better high-skill jobs, and more sustainable cash dividends, share repurchases, and capital gains for the typical stock market investor. Goldman Sachs chief economist Jan Hatzius says the Federal Reserve's exit strategy makes sense ahead of Fed Chair Janet Yellen's step-down in 2018. The highly probable shrinkage of Fed's $4.5 billion balance sheet will phase out over the next few months before the next leadership transition. This shrinkage accords with the Federal Reserve's likely interest rate hike later in 2017. Targeting inflation at a little over 2% per annum, the Federal Reserve reacts to high stock market momentum with a more hawkish monetary policy stance. Favorable macroeconomic data such as better industrial production growth and manufacturing job creation support the next interest rate increase. In response, the U.S. greenback tends to appreciate while American economic growth rebounds to attract capital flows back from emerging economies at the medium stage of the global financial cycle. With free international capital flows and flexible exchange rates, the current Fed interest rate hike is likely to lead non-U.S. monetary contraction worldwide over the next few years, aka the Mundelean international finance trilemma. Trump and Xi meet in the most important summit on Earth this year. Trump has promised to retaliate against China's currency misalignment, steel dumping trade practice, manipulative ownership of U.S. government bonds, and passive attitude toward the deterrence of North Korean nuclear threats, whereas Xi serves as a pacifist to Trump's allegation of currency manipulation as the main reason for American $500 billion trade deficit. The Trump stock market rally reveals that much economic policy uncertainty revolves around whether the Republican administration would impose a new punitive 45% tariff on Chinese imports to counteract the current trade imbalance between the world's most powerful economies. Many political considerations such as the One China policy and the anti-nuclear deterrence of North Korea come into play and affect the U.S.-China economic status quo. Can the Trump administration's economic sanctions manifest in the form of punitive tariff and trade protectionism as quid pro quo for political concessions on the One China policy and East Asian nuclear non-proliferation? The heuristic rule of accumulative advantage suggests that a small fraction of the population enjoys a large proportion of both capital and wealth creation in a given economy. This Pareto puzzle persists and prevails in the world's core economies such as America, Australia, China, Europe, Japan, and even Russia. In corporate strategic management and industrial organization, a slightly better product or service often leads to dramatically better sales turnover and net profit margin over many years. Modern examples include Apple's iPhone and iPad, Google's search engine, Microsoft's software design and development, Amazon's e-commerce platform, and Facebook's online social network. Each of these technological advances represents the cutting-edge and one-of-a-kind proprietary innovation under U.S. patent protection. Is it about time for us to reassess the root causes of this Pareto puzzle in the stock market, that is accumulative advantage versus competitive advantage in the prescient words of Professor Michael Porter? From 1927 to 2017, the U.S. stock market has delivered a hefty average return of about 11% per annum. The U.S. average stock market return is high in stark contrast to the average returns on bonds, currencies, mutual funds, exchange funds, warrants, and commodities such as gold, silver, oil, and wheat. Behavioral economists such as Nobel laureate Richard Thaler have coined this macrofinancial anomaly the equity premium puzzle. This equity premium puzzle suggests that the U.S. double-digit performance is too high to reasonably reflect the typical investor's relative risk aversion in light of low consumption growth. While many scholars strive to resolve this equity premium puzzle with complex math models, some recent evidence suggests that the American stock market experience proves to be the exception that defies the rule of thumb. In other words, the American stock market stands out of the international crowd in terms of long-term average aggregate performance. Positive U.S. investor sentiment highlights the long-term outperformance of the U.S. stock market relative to many other asset classes. U.S. stocks remain the primary investment vehicle for most global institutional investors and North American retail investors. Information technology usage, diffusion, and proliferation have spurred the U.S. spectacular stock market vibrancy over the past few decades. As the biggest IPO since Alibaba in recent years, Snap Incorporated with its novel instant messaging app Snapchat achieves $30 billion stock market capitalization. Having raised more than $3 billion from its IPO, Snap easily beats the bid price that Facebook offered back in 2013. In this modern era of digital technology, many financial economists and market observers suggest that unicorns, or tech startups with $1 billion net worth, often seek to be packaged as profitable M&A targets for large public corporations. Snap demystifies this unicorn puzzle by going public with its stellar stock market performance and millennial popularity. As the White House economic director, Gary Cohn suggests that the Trump administration will tackle tax cuts after the administration repeals and replaces Obamacare. The dynamic scoring modus operandi helps economic advisors assess both costs and benefits to ensure tax revenue neutrality over a 10-year period. A border adjustment tax on most imports from China, Mexico, Japan, and other countries will be a major source of public finance for this fiscal tax optimization. Subsequent greenback appreciation can then neutralize the inflationary effect of this border tax. The current interest rate hike will contribute to this dollar appreciation for better current account neutrality. Mainstream media has speculated that Gary Cohn might be a good candidate under consideration for the top post of the Federal Reserve after Janet Yellen steps down as Fed chair in February 2018. However, President Trump should probably keep Cohn in his current role as White House chief economist to lead the fiscal tax overhaul program through congressional confirmation and scrutiny.